Pimco, one of the world's largest bond managers, has cautioned that President-elect Donald Trump's economic policies could lead to an overheating U.S. economy, potentially halting interest rate cuts and posing risks to the stock market, which has rallied since Trump's election win. Dan Ivascyn, Pimco's chief investment officer, suggested that U.S. stock markets might face a downturn after the surge following Trump's victory. The S&P 500 and Nasdaq Composite indexes have recently reached record highs, driven by expectations of tax cuts, reduced regulations, and trade tariffs. However, Ivascyn warned that such reflationary policies could trigger inflation in an already robust U.S. economy. It's not as straightforward as a one-way reflationary trade that benefits risk assets, Ivascyn told the Financial Times, cautioning that there is some risk that some of this exuberance could feed into inflationary expectations or actual inflation. He noted that Trump's policies are being proposed at a time when the economy already has considerable growth momentum, which could lead to overheating. Ivascyn's concerns align with those of other investors who worry that the market's strong response to Trump's win may clash with potential inflation increases and a long period of tight monetary policy. Expectations around U.S. interest rates have played a central role in market trends in recent years. While the S&P 500 gained over 4% this week, set for its biggest weekly increase this year, Trump's win has also pushed Bitcoin to new highs and driven junk bond spreads. The extra yield on lower-grade debt over Treasury bonds to their lowest point in 17 years. Government bonds initially fell sharply this week due to inflation fears, though the 10-year Treasury rebounded after Fed Chair Jay Powell said it was too early to assess the impact of Trump's policies. Though Ivascyn does not anticipate massive inflation, he acknowledged that Trump's policies could support long-term growth. He also noted that this could eventually lead the Fed to become more cautious, potentially slowing down rate cuts in response to growth dynamics. The Federal Reserve has already slowed its pace of rate cuts, following robust economic data in recent weeks, despite a weak October jobs report influenced by strikes and hurricanes. The Fed recently reduced rates by 0.25%, setting them at a range of 4.5% to 4.75%, following a larger half-point cut in September the 1st since 2020. Market trends this week indicate that traders are lowering their bets on further Fed easing in 2025, expecting fewer than 1 percentage point of rate cuts by next year's end. Ahead of the Fed's announcement, Ivascyn remarked that the bar will be high for any future rate increases, suggesting a likely scenario in which the Fed could hold rates steady for an extended period. Such a scenario might not favor the commercial real estate sector, which has recently rallied on hopes of further rate cuts. Ivascyn also highlighted that markets often act in anticipation of the Fed's moves, adjusting for changes in inflation and rate outlooks without needing explicit signals from the central bank. At a certain point, expectations of rising inflation and elevated interest rates could drive Treasury yields to levels that make them competitive with stocks, reducing stocks' appeal, Ivascyn explained. There are practical limits to how high rates can go before they begin to negatively impact risk assets, he added, noting that such an environment could reverse recent positive market momentum. He concluded, "The markets themselves often act as a form of restraint." Thank you so much for watching. If you found this video helpful, make sure to give it a thumbs up and hit that subscribe button for more awesome content just like this. Don't forget to turn on notifications so you never miss out on our latest uploads. And as always, I'd love to hear your thoughts in the comments below. Until next time, stay awesome, stay inspired, and I'll see you in the next video.